Hi, I'm Dave Getz from West USA Realty, and this is my main man for lending, Ron Kuhn from Summit Funding. And I heard this is your first day on the job, right?
Absolutely. I've been here for 40 years and I'm staying.
40 years and a day. Okay, all right, glad to hear it. Well, recently the Fed's announced a couple of changes to mortgage rates, and we're going to talk about those. The first one was they said that the interest rate is going to go up on March 1st. So my question is, do you think that's going to happen like right on March 1st or a little bit later, or what do you think?
So here's what's happening. About a week ago, the Federal Reserve made several huge announcements. One was that they were going to raise the Fed funds rate. And what that is the rate that banks exchange money at. That ultimately costs us more money as that rate goes up. Additionally, they're going to stop subsidizing the real estate industry. They've been buying what's called mortgage-backed securities for the last 2 years, trying to spur low interest rates, fuel the economy, literally make us feel better through this whole COVID pandemic. COVID's leaving us, so are the stimulus packages.
And let's hope it's leaving us.
Yeah, and the result is interest rates and prices will continue to escalate. So the message here is if you really are looking to buy up or buy down or buy into a new neighborhood or a better school district, do it sooner rather than later, because both prices as well as interest rates will most certainly be higher as the weeks and months progress on.
Okay, and then the second announcement concerns second mortgages for second home. So, well, first of all, what's the difference between a mortgage for a first home and a second home?
Primary home means you're going to live in that house as your primary house. You're going to be in that home 6 months or more out of the year, and that's where your employment's at, or you're maybe a remote worker working from home. All that's good. Vacation property or second home would be a home that you use just for the fun and enjoyment of you and your immediate family to vacation in. There's no limit or no requirement on how much you need to be there. The only real requirement is you cannot rent it out because it's a vacation home, not a rental property.
For how long?
The deed of trust that gets signed on every single transaction that's a vacation home says that you've got to honor your occupancy for a minimum of 12 months. Okay. So you buy the house as a vacation home, you move in, you use it for fun for the first year. After that 12th month, you can freely rent it out at your leisure.
And does the government give maybe a little bit of motivation to not cheat on that and say it's your primary when it's really your secondary?
Well, the motivation is if your number gets picked and they audit the file and they go out to the house and they got a renter in there and you don't have a really good story behind why that renter's there, you go to jail for loan fraud.
Yep.
It's a federal offense.
It's a biggie, so you don't want to do that. Okay, so now what's the difference between a second mortgage, second home, and an investment property?
Okay. Primary homes, for the most part, when you're talking conventional financing, require 5% down. Vacation properties, minimum down payment is 10%. Investment properties, where you're going to rent it out or Airbnb it, minimum down payments are 20%. So you can see that the more aggressive lending, primary to vacation to investment, the skin in the game, the down payments become greater. But also the risk to the agencies, Fannie Mae and Freddie Mac, becomes greater. Because when lightning strikes and you have hard times come on you, you will break your tail to save the roof over your head, your primary home.
Okay.
If you've got vacation homes or rentals and things get really tough, it's much easier to mail in the keys.
Yeah.
So consequently,
makes sense.
The agencies have bigger defaults on vacation homes and investment properties.
Yeah.
Well,
no, wait a minute. You mentioned Fannie Mae and Freddie Mac. Is this like a couple on a sitcom, or who are these people?
Yeah, Fannie Mae and Freddie Mac are the agencies on Wall Street that buy and securitize conventional loans.
Okay.
And so when you're not going to be living in that house as your primary home, you're no longer eligible for government-funded financing like FHA and VA, and you fall into that world of Fannie Mae and Freddie Mac because it's a conventional loan.
Okay, all right. So basically what you're saying is a second home, the requirements are basic, and the fees going forward are basically going to be the same as an investment property, with the exception of you can still do 10% down.
Yeah, exactly. So the agencies have determined they've got a way bigger risk in vacation homes than they ever thought they had. Mm-hmm. Way more of those are defaulting.
Right.
And so literally coming up for all contracts that are dated after the middle of February, the rate, the cost of a vacation property home loan is going to increase dramatically. It's not going to make it unattainable, but it's going to be a whole lot more expensive and similar to the higher rates associated with investment properties. And to kind of give you an example, today compared to where the world was at just a simple 30 days ago, if you had a $400,000 loan that you were doing on a vacation property, the cost of that interest rate will literally be $16,000 more expensive in this new world. And so it's going to force you into looking at potentially higher interest rates to reduce that cash investment.
Now, is that 16,000 in higher interest rates over the course of the loan?
No, it's
Okay.
all due and payable the day you close. It's
Okay,
literally
so
the cost of the
you
rate.
buy down the rate,
Yeah.
and it costs 16,000 compared to what would it be?
30 days ago. So think about this. In all the years past, and again, I've mentioned earlier, I've been doing this for 40 years, vacation homes have always been priced interest rate wise exactly like primary residences. So if primary residences today are running between like 3 3/4 and 3 7/8% interest rates, in the old rules, you could get that for vacation property. Today, to get that rate, the cost is increased on that size of a loan, 400,000, using 10% in down payment, the minimum. It's increased like 16,000 bucks. The only way to mitigate that additional cash out of pocket is to take a higher interest rate with a lower cost to it. So all the rates begin to escalate. So
And that would actually cost people a lot more in the long run, right?
well, yes, because the interest rate's higher, the monthly payment's higher. So if they have the funds, buying down interest rates today is a good idea because it may be the last bite at the apple that you have before these interest rates continue to escalate. It's not getting lower, they're getting higher.
Okay, so last question is, let's say somebody puts down 20% instead of 10% on the second home. How much does that save them some money?
It does. In both in investment properties and in vacation properties, the more money that's invested, gauged in 5% increments. It's 10% down, 20% down, 25% down. Each time you put more money into it, the risk to the agencies is a little less, and they lessen that cost. So again, a parallel. Somebody with good credit back on that $400,000 loan, 10% down is going to cost them about $16,000 to buy that lower interest rate. 20% down is going to cost them more like $12,000 or $13,000. So that cost differential, that what Fannie and Freddie call that loan level price adjuster, will get better with bigger down payments. But no matter how deep you go, unfortunately, it's still going to be a more expensive rate in tomorrow's world, which starts literally on the middle of February.
Okay. And in the real world too, a lot of times you might not have the 20% or you might not have the 20% plus the extra cost to buy it down. So, you might not be able to, but again, it's not all that much money difference between the two.
Put reality on it. When we talk about a 1% difference in interest rate on that $400,000 loan, it's something less than $190 a month in a monthly payment. So, yeah, it's going to cost you more, but it's not thousands more. You're talking a couple $100 more a month, a little higher interest rate, and second homes, vacation homes, especially here in Arizona. This is where everybody wants to come.
Yeah.
We're going to continue to do them and do a lot of them. It's just that the people that are going to buy into those homes are going to have to be ready for that interest rate shock of this is more than the last time I bought a vacation home because the rules have changed.
Yeah, and those of us who've been around the block a few times, today we think 4.5% is like crazy. The world is falling, the sky's falling, but I bought my own house in 2001. We paid 5 3/4%. Thought we were getting a great deal. So 4.5 still isn't that bad. But how long do people have? Like, if you're going to do a second mortgage, how long do people have to get under contract to avoid those fees, or can they even do that?
If you want to achieve the legacy fees, the legacy program of Fannie and Freddie, you literally have to be under contract by February 15th.
Okay.
Because it takes me 30 days to close your loan, and I need till the middle of March to get it done, and that's when the new rules take effect.
All right, so we're videoing this as of February 1st, so right now you got 2 weeks, and then the rates are going to go up but that's only for the second homes. Now, as far as primary residents, they've already started to creep up, but they're still awfully low.
Still in the
below
threes.
4. Yeah.
Exactly. So nothing's going to deteriorate, nothing's going to break down, the world continues. People will still buy vacation homes and investment homes and primary homes, and the rates, like you say, it's not that bad.
Yeah.
It's just back to reality.
Yeah. However, if you do want to get the best rate possible,
Jump fast.
Right now is the time. So yeah, jump on it as fast as you can. Just give me a call, and I can put you in touch with Ron. He can set you up to get a pre-qualification. And by the way, we have to have that pre-qualification form filled out. So people start looking online, and they're spending all this time looking online for a house they can't buy because they haven't been pre-qualified yet. So call me, and I'll put you in touch with Ron. He can get you pre-qualified, and then we can go out and find a house. So Thanks a lot.
Thanks
Bye.
for dialing in.
Okay, bye.